Hey boys, I hope you're all doing really well. So yes, a lot of students reached out to me asking me a small concern. People told me that while they're able to understand the subject of capital gains, it becomes a little difficult when a lengthy question comes in exam, especially with the topic called as immovable properties. They're able to comprehend the subject, but at the same time, the application does not really make sense. And therefore, they wanted a more simpler format on how they can understand capital gains and do it well in the exam. People, this topic is a little critical topic because it carries 4 to 6 marks in your exam. It comes as question number 3. And therefore, I do want you to pay special attention to this topic, especially if you're writing the upcoming exams of May, September and Jan. Yes. So without wasting any further time, let's discuss this topic in detail and let's understand what and all should you be keeping in mind when discussing about capital gains of immovable properties. Yes, before you is a format which I have prepared summarizing the whole extent of the provisions which are applicable for an immovable property transfer. You just need to keep all these in mind before you go for your exams. What are these topics? Let's discuss it together in detail. The first thing is, people, when you start with capital gains, the first and the most critical thing is full value of consideration, basically your sale value. Now, when it comes to immovable properties, income tax has a special provision under section 50C. Yes, a special provision has been imbibed under section 50C, which comes and clarifies that if you're planning to transfer any immovable property, you need to check 3 items. First, what is the stamp duty value as on the date of agreement or on the date of transfer, depending on when did you receive the money. If you have received the money on the date of agreement, at least a portion of it in permissible modes, your account pay check, account pay draft, electronic clearing system, other permissible modes, then you can take the SDV on the date of agreement. If not, you will have to take the SDV on the date of transfer. This value will be compared with the value which is arrived by the valuation officer, and whichever is beneficial will be taken. Therefore, whichever is lower. The final answer which you get will be then compared with the actual sale consideration to find out whichever is higher. So in simple words, the full value of consideration will be STV as on the date of agreement or transfer as the case may be, versus valuation officer FMV, whichever is lower, compared with your actual sale consideration, whichever is higher. But please note this carefully, that this provisions will only come into picture if you come and tell me that the stamp duty value is more than 110% of the consideration. Which means if the STV is within 110% of consideration, the provisions will not apply. You will ignore everything which is given on the top and you will directly do what is called as the actual sale consideration. Yes, in which case you will directly take the actual sale consideration as the case may be. Agreed? Yes? Super. Let's move forward. After you arrive at the full value of consideration, you reduce your transfer expenses. What are transfer expenses? All those expenses which you have incurred during the sale value. Like for example, the question may say there is some registration cost. Yes, so you remove that registration cost if you have paid the expenses. If you have paid the expenses, you can claim it as deduction. After you reduce this number, you will arrive at something called as net consideration. Now, if you have done with the net consideration, you will then start looking for the cost of acquisition. From here, things become a little complex, so therefore pay attention. Income tax says that when you have a cost of acquisition, you will check whether the cost of the acquisition is before 1st April 2001 or after 1st April 2001. If the asset was purchased before 1st April 2001, you will take the FMV of 2001, STV of 2001, whichever is lower, and that will be compared with the actual say cost of acquisition, whichever is higher. Yes, so again the same logic as your full value of consideration, people, take the FMV or STV whichever is lower and then compare it with your actual cost of acquisition, whichever is higher. But if you are acquiring this after 1st April 2001, I have no concerns. Directly take the actual cost of acquisition itself. That will be the final number. But after you've arrived at the cost of acquisition, income tax also says that in the past years, if you have forfeited any advance money for the transfer, you will reduce the advance forfeiture as well. But this advance forfeiture will only be reduced if the advance forfeiture was done before 1st April 2014. So if you have done a forfeiture before 1st April 2014, you will reduce it from the cost of acquisition in order to arrive at the net cost of acquisition. But if the forfeiture took place after 1st April 2014, ignore the number. This number will only be taxable under IFOS in the year in which it was forfeited. So if it was any time before 2024, which is your current previous year, you may choose to ignore it because that is already part of your IFOS statement when it was forfeited itself. Only take the cost of acquisition reduction for forfeiture when it is before 1st April 2014. Great. After you're done with your cost of acquisition, you will move on to cost of improvement. Again, in cost of improvement, income tax says, tell me is the cost of improvement made before 1st April 2001 or is it made after 1st April 2001? If you tell me that it is made before 1st April 2001, I will say go forward and ignore it off. Go forward and ignore it off. But if you say it is made after 1st April 2001, I will say you can consider it as a cost as well. Consider it as a cost as well. That can also be claimed as a deduction. Yes, this is what the format is. But considering the current particular year, people, financial year 24-25, you will have to check when does the transfer take place. If the transfer takes place before 23rd July 24, if the transfer takes place before 23rd July 24, then you can't take the cost of acquisition or cost of improvement as it is. You will have to index it if the asset is a long-term capital asset. Yes, so income tax is coming and telling if it is a long-term capital asset, index both cost of acquisition and cost of improvement. The formula for indexation is take the actual cost of acquisition or improvement and multiply it with the CII in the year of transfer divided by CII in the year it was acquired or in the year it was improved, as the case may be. Yes, so that is what the provisions is. So if you're going to index, you're going to index using CII in the year of transfer divided by CII in the year of your acquisition or improvement. If the question does not mention the CII for that particular year because it was before 2001, then take the 2001, which is 100. If you do this whole computation, people, you'll arrive at what is called as a long-term capital gain or short-term capital gain. Yes, I'm repeating the whole format once again quickly for everyone. It is starting with full value of consideration, where you take the stamp duty value or fair market value, whichever is lower, compared with the actual sale value, whichever is higher, but take that only if the stamp duty value is more than 110% of consideration. Reduce the transfer expenses, arrive at net consideration. In the net consideration, you will reduce the cost of acquisition. Before 2001, you will take the FMV or STV on 2001 compared with the actual cost, whichever is higher. And if it is after 2001, take the number as it is. If it is going to be cost of improvement, again check if it is before 2001 or after 2001. If it is before 2001, you can take the you should not take any value, but if it is after 2001, take the actual cost of improvement. Whatever numbers you have in cost of acquisition and cost of improvement will remain as it is unless the transfer took place before 23rd July. If the transfer took place before 23rd July, you will index these numbers as well. Which means take the cost of acquisition, cost of improvement, multiply it with a CII in the year of transfer divided by CII in the year of acquisition or your improvement. This will arrive at your capital gains. People, if it is a long-term capital gains, the period of holding will be shown as more than 24 months. And if it is less than 24 months, take it as short-term capital gains. Yes, this is the first step. Then comes in second step, where you have to start claiming exemptions. Please notice one thing very, very carefully, that these exemptions will only be granted if your asset is a long-term capital gains. If the asset is a short-term capital gains, there is no exemptions for you. You will arrive at the number as it is. The number received previously is the final answer. But if the asset is a long-term capital gains, you can claim two exemptions from your immovable properties. First exemption, people, is section 54. Where it says, because you're transferring an immovable property, if you buy a second immovable property, you will be allowed an exemption under 54. How much can you do? You can invest only in one house property. That too, the property should be in India. But if you come and tell me that your long-term capital gain is less than or equal to 2 crores, I will permit you to also buy two house properties in India. By when should you buy? You should buy this 1 year before or 2 years after the date of transfer in case you're purchasing. And if you're constructing, then you should complete it within 3 years. But during all this notion, you have to ensure that the money is invested in CGAS before the due date of return filing. So which means if you're already investing before the due date of ROI, there is no problem. But if you're not going to invest the money in the house directly, then you have to put the money in CGAS before the due date of ROI. Only that much of money which is put in CGAS will be allowed as an exemption. Otherwise, you will not get an exemption. What should you be investing? You should be investing your capital gains, as the case may be. And therefore, you can only claim an exemption maximum of 10 crores. That is what the limit is. Which means if the question comes and says that the person has invested more than 10 crores, assume that you can only invest 10 crores and that is what you can maximum claim as exemption. The second exemption will come in for section 54EC. This section 54EC says if you're planning to buy any kind of RECL bonds, NHAI bonds or any other notified 54EC bonds, then you will be given an exemption under 54EC, provided the investment is done within 6 months from the date of transfer. Notice there is no CGAS here. Yes, there is no CGAS here. You'll take the number as it is. You'll take the number as it is, and then you will come and do a maximum investment of 50 lakh rupees only. You cannot make an investment more than 50 lakhs in this case. If you invest more than 50 lakhs, income tax will assume a restriction of 50 lakh rupees. Once you take this exemption as well, along with 54, you will arrive at the final taxable long-term or short-term capital gains. Yes, this is what would be your 6-mark question. This is what would be your 6-mark question, where you will have to be asked to arrive at this long-term or short-term capital gains. However, in the current year, assessment year 25-26, there are some amendments in tax rates, and therefore for an MCQ question, this may also be relevant. What is the amendments? Income tax says if you are going to start paying taxes on capital gains, tell me what kind of asset is it. If it is a short-term capital gains, then you tax it at the slab rates. The normal rules, everything will apply. Yes, but if it's going to be a long-term capital gains, and if you're transferring before 23rd July, notice carefully, before 23rd July, you would have already applied indexation benefits. You would have already done indexed cost of acquisition, indexed cost of improvement, and therefore the tax rate will be 20%. The tax rate will be 20%. Whereas if you're transferring after 23rd July, you will not be doing indexation. You'll not be doing indexation, and therefore as a one-time measure in the current year, income tax says even if you're transferring after 23rd July, check whichever is better. Which means you will still do tax as per 20% by applying indexation, or do tax as per 12.5% without applying any indexation, and check whichever is lower. That will be your final tax payable. Which means you may expect a question in exam where they may come and say that there is an asset which is transferred after 23rd July and they are asking you to compute the tax liability. Please note that you will not just do 12.5% in this, you will also do 20% with indexation, and check whichever is lower. This is a silent adjustment for your exam, so please pay attention to this. Yes, sweet. This is all that is your format for your capital gains, people. A very, very easy, simple format if you understand to compile the whole thing together. Yes, so we start with full value of consideration, reduce transfer expenses, reduce cost of acquisition, reduce cost of improvement, arrive at capital gains, claim exemptions of 54 and 54EC, arrive at taxable capital gains, and then apply these tax rates. For your full value of consideration, simply do STV or FMV on the date of transfer versus your actual sale consideration, whichever is higher. You can also take the agreement date if you have received advance money by permissible modes. Do not apply these provisions if your STV is within 110% of consideration. In cost of acquisition, check whether it is before 2001 or after 2001. If it is before 2001, again do FMV or STV on 2001 versus your actual cost, whichever is higher. If not, your after 2001, take the actual cost of acquisition as it is. From this, you will reduce your advance forfeiture if at all the forfeiture has taken place before 1st April 2014. In your cost of improvement, if it is before 2001, you can ignore it as it is, but if it is after 2001, you can take the actual cost of improvement, and at the end of the day, you will arrive at your capital gains. If it is more than 24 months of transfer, then you will take long-term capital gains. If it is less than 24 months of transfer, you will take short-term capital gains. Yes, sweet. This is the simplest format which is there for your exams, people. Nothing complicated about capital gains. Please go back, keep this format intact, and try to solve one question from your ICI study material. See if you're able to now reconcile this. If you're able to reconcile this, then amazing. Great work you have done till now. If you're still not able to reconcile it, please drop in a comment on the bottom or reach out to me on my WhatsApp number and we can discuss this together. That's it, people. I don't want to spend any further time during your exam times. Focus on this topic, an important topic, and can come in your exams for 4 to 6 marks. So pay attention to this. That's all for today's video. I will see you all with further videos and further updates. Until then, happy learning. See you. Take care.